Josh Duvall, certified financial planner, registered tax preparer from joshuaduvall.com. And today I wanted to bring you a simple video about a topic that gets talked about a lot, especially as we head into election season. And the topic is this: how do presidents affect the stock market? So first, let me say that obviously, regardless of your views on President Trump, one of his big selling points or talking points is that the stock market has been incredible under his administration, under his policies. He's very boastful about the stock market, and he claims that if Joe Biden gets elected, that the stock market's going to go to hell, it's going to be destroyed, your 401ks will be destroyed, all sorts of things related to the supposed policies or ideas of Joe Biden and the Biden administration relative to the stock market. So I just wanted to bring in some data, some historical data, and kind of attack this whole argument about presidents in the stock market kind of at a fundamental level. So first, there's something that needs to be said. Number one, the stock market does not equal the economy. So during the pandemic, obviously, when coronavirus started, January, February, if you go back and look at some of the videos that I made, I was actually, out there saying that there's going to be some major issues economically with this virus. And obviously we saw that. If you go and look at charts of the coronavirus, I mean, they talk about a V-shaped recovery. That's what it is. Massive drop in the stock market, and it's essentially come back or is now positive from where it dropped in the months of March and April and May. And economically, what happened? Obviously, the economy has not recovered as quickly as the stock market has recovered. The stock market is not the economy. That's a micro version of an example, but I think it's important to understand that. It doesn't correlate to the economy. Over large time periods, it does. And what we've seen historically is that essentially the stock market always goes up. Over long periods of time, the stock market always goes up. Now, we can get into the details of different crashes or different periods, boom and bust cycles of the economy, and how that correlates to presidents. But a simple chart that I wanted to share with you goes back and looks at from 1979 through 2019. So yeah, 40 years of data related to the Russell 3000. This is one of the most broad-based indexes, which represents a huge number of American companies, large cap, mid cap, small cap, etc. So a very broad swath of the U.S. stock market or of publicly traded companies. And what we find is that apart from George W. Bush, and we'll get into that in a second, essentially the stock market all performs relatively equally over that 40-year time period. If we go back even further, you'll find those averages leveled out even more. So the difference between presidents, there are percentage point differences, but it's not massively different. And I think there's a few reasons for that. Number one, our economy is based on innovation and being able to innovate, create new products, create new services. Obviously, we have a country that's population is growing. We're the leader of the world as far as global economic activity with regard to innovation, product creation, new businesses. We have tons of businesses that are domiciled here. We have a global economy, so we're a huge consumption nation. We have a ton of tech. That's really the future of innovation, which kind of exists and has not only started but has really been maintained in the United States. Those levels of innovation, the way that our country continues to create entrepreneurship and incentivize people to take risks to start businesses, those businesses succeed, and then and that goes on to create economic activity, new jobs, consumption, spending, etc. It's just a cycle that continues to carry on and grow as the economic activity grows. So I think it's important to realize that as long as the structure of our economy is capitalistic in nature, we're definitely not a free market economy. We're a heavily regulated economy. We're a heavily taxed economy, especially when you compare with other nations across the globe. So those things are in line with Europe and Asia and so forth. It's really about innovation, creating new products, and being able to market and sell those products around the world. The second thing that I think is really important to talk about is the activity of the Fed. So the Federal Reserve is a organization. Some people call it a cabal, but in fact, I'll just give a side note. If you've never read The Creature from Jekyll Island, I think it's a pretty interesting book. It talks about the beginnings of the Federal Reserve, and it's certainly slanted. I mean, it's a opinionated piece on how the Federal Reserve started, what the purpose of it is. But the Fed comes out and also states that their goal is to depreciate our money via inflation and to drive economic activity and growth. And they do that through all sorts of ways. If you remember the financial crisis of 2008, that's why we talked about George Bush earlier and how he's the only president that has a negative return over his tenure in this last 40-year period. So that's Reagan, Bush #1, Clinton, Bush #2, Obama, Trump. The only one who has a negative return of this Russell 3000 index is George W. Bush. And the reason for that was the mortgage crisis, was the financial crisis, the collapse of the housing market. And again, we could talk about why that is, but the Federal Reserve has a huge role to play in driving stock market growth. There's an old Wall Street adage which is "don't fight the Fed." And what that means is when they say they're going to provide economic stimulus, when they say they're going to keep inflation low or pursue inflation or try to manage interest rates or do things with capital expenditures and the balance sheet of the Fed, bond buying programs, all of the things that they talk about, and that's you can there's people whose whole careers are built on just analyzing Fed policy. But essentially, the goal of that organization is to manage inflation, which is the depreciation of our money, and to drive and control and moderate economic expansion. So that's the stated purpose of the Fed. And those types of organizations, those two things that we mentioned, innovation as far as our economy is concerned, capitalist economy, and Fed managing inflation, interest rates, etc., have essentially equated to a bull market that runs essentially continuously. On a micro level, yes, there's ups and downs. Our most recent was obviously the pandemic of this year. If you go back and look at the year 2018, that was kind of a flat or negative year in the stock market. 2017 was big after the Trump election. 2018 was flat. 2019 was another huge, great year. Obviously, 2020 is slightly positive. We'll see what happens with the election and how it ends out, rounds out the end of the year. But if you go back and look at these cycles, what you'll find is that economic activity continues to expand, the stock market continues to expand, and there's a lot of driving forces that are not related to the president. Now, the third thing we have to talk about is administrative policy, or the president's policies. And there's kind of two ways to think about this. First of all, we have to understand and think about short-term versus long-term. Big businesses do not make rash short-term decisions. So when you think about tax policy, for example, obviously with the Trump Tax Cuts and Jobs Act, the idea was let's cut corporate taxes, which reduce the income tax that businesses pay, and let's provide income tax relief to middle income families. The idea is that by doing that, they'll be able to have more income, they'll be able to spend more income or start a business. Businesses will be more likely to do business in the United States because we'll have a much more competitive tax rate, and that's kind of the thinking there. The other side of that coin, if you think about maybe the bull market case for someone like Joe Biden, is that you use fiscal policy to create higher employment and more income for the lower income individuals in our economy. That creates more consumer spending, and consumer spending drives the stock market. My point being that if you look at Democrats and Republicans, regardless of what the policies are, the stated policies, the things that they say they're going to do, historically, of course, future results are not determined by what happened in the past, but historically, there is not really a massive difference between presidential terms or policies and their effect on the stock market. There just isn't that big of a difference. Over this chart that I was referencing earlier, you're looking at a 40-year period. Trump is about 14%. Obama was 16.5%. We talked about Bush being -3%, and the housing crisis is a great example of that. Bill Clinton was at 16%. Bush 1 was 15%. Reagan was 14%. There's lots of things that bring out those numbers. But again, we have boom and bust cycles in our economy. There will be, we had the financial collapse of 2007 and 8. Obviously, we had the pandemic this year. There's going to be additional boom and bust cycles. That's reality of the stock market. But ultimately, if you're thinking about voting, or worse, thinking about making financial decisions dependent upon investment decisions, dependent upon who gets elected, I think you really need to step back. I think there's an idea that the stock market is this huge thing, and presidents are totally in control, and certainly Trump plays that out and talks about that a lot. But your investment decisions should not be determined by the rhetoric or even the policies of a president in the short term. Your investment decisions should be based on your goals, on your time horizon, on your risk tolerance. Presidential policy or presidential rhetoric, regardless of the candidate, regardless of who you're voting for, your political views, this is not a political video about who you should vote for. This is a video about how does a president affect the stock market, and that begs the question, should you be making decisions relative to your investments or taxes as a result of a presidential election? The bottom line is your decisions should be made by you, and the inputs, presidential policy, tax policy, investment opportunities, those are inputs that go into decision making, just like a billion other inputs that go into decision making. To weight massive amount of your decision making on investment style or allocation or diversification or stocks or choosing not to invest, right? Holding in cash or buying gold or doing any of these massive changes to your investment program as a result of what someone says they're going to do or what someone says the other guy is going to do, I think that's a very short-sighted way to look at it. Historically, it's certainly short-sighted. Apart from massive financial changes and financial events that aren't related to an individual. George W. Bush is not the reason why the financial crisis happened. The financial crisis was the result of subprime lending, which went on for decades and decades and came through a boom and bust cycle that ended up just blowing up as a huge asset bubble in 2007. There's lots of research you can do on that. It predated George W. Bush and had nothing to do with him. George W. Bush could be blamed for a lot of things, but it's not the financial crisis. So I think it's important to realize that as we kind of recenter on you as an investor, on you as a pre-retiree, as a worker, as someone who's trying to build wealth and plan for the future, the issue isn't presidential rhetoric, even presidential policy. Once those things come about, then fine. That's an input that you use to make decisions. But please don't make massive structural changes to your investments because of Donald Trump or Joe Biden. Your investment policy, your financial future should be far above and beyond the reach of a presidential candidate or their rhetoric leading up to an election. So if you have questions about your investment philosophy, if you have questions about what you're doing in your 401k, your retirement accounts, your 529s, your individual accounts, if you have tax questions, policy issues, and wondering how things might affect you going forward, I'd love to discuss that with you. Feel free and shoot me an email, josh@joshuaduvall.com. Again, that's josh@joshuaduvall.com. Certainly go out and vote if you haven't already. Yes, there's going to be challenges ahead regardless of who wins. There's going to be lots of things that concern us about the stock market regardless of who the president is. And your goal, your objective should be to continue on saving your money, investing for the future, being as tax efficient as possible, and really working a plan that works for you. Your goals, your time horizon, your risk tolerance. That's the objective of being a long-term investor. Thanks so much. I hope you have a great day.